How you doing, Adam?
Oh, it was an early morning.
Early morning.
Got my I voted sticker here.
Yep. I
I
think
was
I was
watching.
in I was there at 6:30, I think.
That would have been 30 minutes before the polls even open up here in
Oh,
Massachusetts.
really?
Yeah.
They opened at 6 here. It was pretty convenient for me right across the street. This webinar actually ends our little media week we've had. We've done these a few times for a couple different organizations here.
All right, let's get started, shall we?
Great. So everyone, thanks for joining us today. For those who have joined us in the past, welcome. For those who are new, Adam and I are advisors at Witham Wealth. Adam holds the CFP, or Certified Financial Planning Professional accreditation, and I hold the CFP, CFA, and AWMA accreditations. Today, we are going to spend a little time walking through just a few slides in our quarterly market deck. Please, as always, feel free to ask questions in the question box on your screen. We will monitor and try to answer those questions throughout. And any questions that we aren't able to answer today, we will make sure someone reaches out to you separately in a follow-up. So before we start on the markets, as we always do, we do have viewers of this webinar who are not clients. So let me run through a quick about the firm. Witham was founded to give clients an alternative to traditional and somewhat outdated and commercialized Wall Street approach. At the time, leadership felt there was a fundamental issue with how investment management firms operated. And so we ended up creating a white glove service that eliminates common conflicts of interest in the investment industry to offer what we believe to be a much cleaner advisory relationship. We are what's called a true fiduciary, meaning we are bound to act in our client's best interest when we give advice. Surprisingly, most investment advisory firms do not follow this standard. When we give advice, we want our clients to be able to trust that our advice is good advice. We absolutely do not want our clients to have to take a step back and wonder if we are making a recommendation because the firm can make more money off of it. So we have special precautions, including the fact that we file as a true fiduciary to help limit those conflicts of interest and create what we feel is that cleaner advisory relationship. Now, obviously, there is more to us than just being a true fiduciary. We have highly credentialed staff who help clients plan and invest for every stage of life. We also have institutional level investment reach, giving us an expansive investment universe from individual stocks and bonds to private investments. We also coordinate directly with the CPAs at Withum Smith and Brown on their accounting side to create a family office light type experience for clients who choose to work with both sides of the firm, which is great. I don't know many high net worth or ultra high net worth individuals who cannot benefit from having their advisor and their accounting teams working directly together. You ready to get the show on the road, Adam?
Let's jump on in.
We have to talk about it again. Has the Fed conquered inflation? And I do. I love that word conquered. I love when the media uses it because I imagine, Jerome Powell in knight's armor, sword held high, standing on top of some sort of mythical beast. Uh, you know, do you think Powell can start suiting up for his victory reach?
I
Is that what's
you
called
know,
reach? I don't know.
I think inflation it's coming down. If there was some sort of mythical beast or battle that he's slain, then maybe he's accomplished it. We're progressing towards that track, it seems. And I think it took a lot to get here in terms of the Fed's action. They raised rates from a near zero band to 5.5% on the benchmark rate over the course of a year and a half, 2 years. That was a pretty massive rate hiking cycle. And as we saw recently in September, they deemed that it was time to begin cutting rates. So we've noticed a whole bunch of market shifts taking place under the currents of what is continued economic strength. So I know we're going to dive into that today. I think it's worth noting that inflation probably would have come down anyways, simply because the Treasury wasn't cutting us checks anymore post COVID, and supply chain issues were going to work themselves out anyway. So I don't know if Jerome Powell wants to take credit for the job well done that he's accomplished, but as consumers, a lot of our debt these days fixed. Most people, 2/3 of the country, have mortgage rates fixed for the next 30 years under 4%. So variable rates are fewer and farther in between in terms of our loans today as consumers. So it's unknown if really hiking rates as much as they did, as quickly as they did, had an impact more so than just the normal cycles taking place.
Right. Something tells me he won't mind taking the credit.
I bet you're right.
That and I'm a firm believer that a lot of what the Fed does is more has a big behavioral component. Allowing investors to understand that someone's doing something about it, right?
Yep.
Now, a resurgence of inflation is not totally out of the picture. It's not what we're saying, but the signs are pointing in the right direction. They are pointing towards the Fed getting inflation to back to where they want to target it, right around that 2% target.
Yeah, there were some more recent sort of high frequency data points suggesting maybe inflation is going to be more sticky than just trending right down to the 2% annualized level. You can see with the latest report from September, we're running at a 2.4% annualized rate. The Fed's target is 2%. The long-term average is around 3%. So we're well on our way there.
And
You
you
can
get to those numbers, Adam, right? We're looking at the monthly number here at 0.2. That's the monthly increase in inflation of 0.2%. You times that by 12, that's how you get to your 2.4, right?
Well, if you add up all these
Oh, okay.
months here over the last 12 months, that's how you get to the 2.4. But we've had bouts and spats of inflation resurgence, I would say, or fears that inflation would come surging back. If you recall, in the spring, winter, spring, January, February, March, rates started creeping back up again, and people were talking about the Fed actually possibly going to hike rates before they cut them at that time period. That clearly came to be false. Um, so, I think we just need to be conscious of the trends that are taking place. And if you look between April and September, sort of the last 6 months of data, it's a much more palatable, 2-ish%, call it, compared to even 6 to 12 months ago. So we're trending in the right direction. And I think what's worth noting here is the June data set, where we actually saw prices contract in June from the year prior. So that was a pretty momentous occasion. I know we're going to get into this later on and talk about some of the underlying shifts in the marketplace that we've seen since that data point released. But I just do want to mention that that was sort of the key point where the Federal Reserve or expectations for the Federal Reserve actually making their first rate cut, a historic event for this cycle. That's when that became a reality, I would say.
Right. Right. So let's move on to the dot plot. So what are we looking at here?
Yeah, so the Federal Reserve, they meet, every 6 to 8 weeks, call it, 8 times a year. And what they do every quarter is they put out their forecast for where interest rates will be at the end of the current year and then the next 3 years, as well as the long run. So along the bottom, you can see 2024, 25, 26, 27, and then the longer run projection. And each one of these dots, this is why it's called a dot plot, but each one of these dots represents one of the voting members of the Fed and where they think they're projecting interest rates to be over this time frame. So at the end of each of these calendar years. And what we like to see is the market being aligned with the Fed projections. That means there's probably not going to be volatility in interest rates in the Fed funds futures market. This is how we can measure this. Okay. So those are those green circles there where the market is projecting rates to be at the various time frames. And the blue boxes are sort of the median or average of all those dots where the Fed voting members who set these rates are actually saying they think rates will be. So we can see that over the long term, they expect to keep rates around 3%, 2.75 to 3% in that range. And the market, as of the end of the quarter, is pretty much in agreement there. Okay. Which is a good thing. I think that's going to cause bonds to hopefully not be as volatile. If you recall, when the Fed was hiking rates, the market was continually underestimating what the Fed was saying and telling us they were going to do. They said, we need to raise rates a lot. Inflation's got to come under control. And the market continually was adjusting higher to meet what the Fed was doing. And right when the Fed cut rates, the market was actually projecting more cuts than what the Fed was saying they were going to do. And the market, since that rate cut in September, has actually come back up to meet Fed expectations. So this has implications for a lot of different sectors, a lot of different types of companies, currencies around the world. And it's worth noting here that, I think it's a good thing, again, that the market is in line with the Fed projections.
Right. And to be clear, we did have a question come in. What are interest rate cuts? So that is what we're talking about. The Fed raised rates, and that is they raised the Fed funds rates, which helps price in, all types of things from loans to investments and things like that. They raised it up, which if you think about a hose with water going through it. They basically crimped the hose. They made it so it wasn't as easy for money would be the water, to flow through the hose. And they crimped it. Now, as they lower rates, they're uncrimping it to let things flow a little bit smoother. So when they lower rates, basically what they're doing is they are lowering how much a borrowing rate will be for you. They're lowering, how much a borrowing rate will be for a company, or mortgage rates and things like that. It all doesn't work in lockstep, but that is the underlying rate that really connects to all these other pieces in the economy.
Yep.
So we've been talking a lot in previous podcasts, our podcast Amplified Wealth, as well as webinars like this one, our quarterly webinars, what kinds of tailwinds we would expect once the market was more confident that the Fed is going to move rates down. And we've definitely seen those tailwinds play out over the short period of time. So let me hop to that.
Yeah, so I mentioned the June inflation report. It was released on July 11th. And so the chart we're looking at here on the screen for those watching, if you're later listening, go and check us out on YouTube. But this is showing a multitude of different asset classes, different types of stocks, and their performance through the end of the quarter since that June inflation report was released on July 11th. And the reason we wanted to focus on, transitioning this date, right? This is, again, when it became evident that the Fed was going to cut rates either at the next meeting or the one after that. It became essentially imminent, right? The next step was down. It was just a matter of when and how much. The Fed did not end up cutting rates at their July meeting. At the end of July, they waited until mid-September before cutting rates, and they did what I would call a double cut, or they went down 2 increments, which is half of 1%. People kind of speculated that they thought that they were too late. Maybe that was a bad thing for the economy. I think they probably just should have done 1 increment each at July and September, and they realized that after the fact and did the double cut there. So I don't think we should be expecting more 50 basis point cuts in the future. They seem to be pretty measured in what they want to accomplish and what they want to do. But again, this has implications for different areas of the market. So one thing we had been telling clients is after the Fed is done hiking rates, you want to typically extend your duration. The reason is you want to lock in those rates at peak rates before they start cutting and lowering rates. So your bond it pays more for a longer period of time and becomes more valuable as rates drop, right? There's a reinvestment risk to having shorter term debt if rates are coming down, because when you renew that treasury, you have to do so at lower rates in the future. So it's better to extend duration when rates are coming down. Okay. So we have that's one situation playing out here. The other aspect of that we had been talking about is the fact that small companies have a lot of their debt and leverage as companies tied to more variable rates, whereas big companies like imagine Apple or Microsoft, if they want to issue debt, they're big enough and powerful enough they can do a fixed rate loan for a period of time, some sort of corporate offering in that sense. Small cap companies tend to be more variable in their loans. So as rates were going up, small companies had a pretty tough time. There was a headwind for them in their profit margins as more and more of their profit margin was being eaten up by higher interest rate costs with those variable loans. When rates became evident that they would start coming down, you saw small cap U.S. companies uh, perform actually pretty well right off the bat, and they've still done well through the close of the quarter compared to bigger companies or tech companies specifically. So that should, if rates continue to fall, that could continue to be a tailwind for their profit margins as less and less of their profit goes towards interest costs. Um, so again, we've got a number of different sectors, asset classes here, and align the performance. You can see long-term fixed income at 5.56% outperformed, the aggregate bond market at 3.84%. And then you can also see that small cap companies performed better than their large cap peers by just under 2%. We could take that a step further, and we would expect with interest rates coming down here in the States, it would make foreign debt more attractive, all else equal. So that could weaken the dollar and be a tailwind for international stocks. And then tech companies, actually, which had been doing really well, hordes of cash on their balance sheets, maybe cutting interest rates is a bad thing for them because all of a sudden all that excess cash is not earning as much and it's not helping their bottom line. So sort of the opposite of small cap companies and why lowering rates could be a headwind for tech companies. So really a pivotal moment for the economy, a pivotal moment for monetary policy moving forward. And we noticed this taking place in the form of, you know, unusual performance relative to the last maybe year or so when the Fed was hiking rates.
Right. If you told many investors in June of this year that a fixed income index, especially a long-term fixed income index that was beaten up in 2022, was going to outperform technology over the next couple of months by over 500 basis points, they would have kicked you out of the room. If they weren't kicking you out of the room, they were looking at you like you had five eyes. But that's part of, our jobs as advisors is to remind our clients and investors of the potential out there, right? We shouldn't always be looking backwards. We should also be looking forwards. And one of the things that we've been pounding the table on over the past year is making sure you stay diversified, because there are a lot of asset classes out there that got hurt when the Fed raised rates, that people kind of threw out to the side. They said, you know what, I don't need these, right? And money started flowing in more and more to what was doing well, the technology names.
Yeah.
But it is important to remember there is a lot, there's a lot going on. We need to be able to stay diversified to some extent, right? We need to, while we need to appreciate technology companies, appreciate the top 10 names in the market weighted indices, we also need to appreciate those other areas of the market that have been set up with tailwinds. Now, we say tailwinds because we're not saying this trend needs to keep up. We're not saying that long-term fixed income is going to, keep outperforming technology by this much or at all over the next 5 years, right? But because there are a lot of cross currents out there, right? So even if long-term fixed income, small cap, et cetera, have these tailwinds behind them, we do need to take into consideration everything else.
Right. We're looking through the lens of, imminent rate cuts only and not
Right.
other economic factors.
Right. Stay diversified. And to be honest, you don't need to go back. You don't need to look at too many reports before you start to appreciate small cap for their long-term outperformance. From a year-to-year basis, they don't always outperform large cap, but over longer stretches of time, you should get a premium, right, for taking on more risk in those smaller cap areas.
Yeah, we can debate that a little bit with more companies staying private for longer, but it has historically been the case. You're right.
Right. Sarbanes-Oxley, was it 2002, definitely put a kink in that hose, but it still plays. Maybe that'll be a topic for another podcast. We can
Let's
bring
do
in
it.
somebody from private equity and in the small cap space. So flipping forward, we're showing a little bit of the same thing, same time period here, but we're focusing more on the Mag 7 versus non-Mag 7 indices. Can you talk a little bit about that?
Yeah, so the Magnificent Seven, if you've turned on CNBC over the last year or two, you've surely heard this term, but this is seven of the largest companies in the world. Alphabet, which is Google, Apple, Microsoft, Amazon, Tesla, Nvidia, and Meta, Facebook. So we just wanted to look and say, all right, on the last slide, we looked at tech companies, and while most of these names are associated with tech companies, half of them are not, right? Tesla is and Amazon are consumer goods. Um, Facebook and Google are communication services companies, so they're not technically in the tech sector. But what you can see is that the Magnificent Seven actually underperformed even technology as a whole, right? So there could have been a big rotation trade going on that people said, okay, new regime, rates are going down in the future after July 11th because of this inflation data being evident. We're on the path to 2% and rate cuts. I'm going to put more money and allocate more money out of these big tech names that have done well and into smaller cap companies. And we use small cap companies in the last slide as a proxy, but we also wanted to break down the S&P 500 and say, okay, how did those Magnificent Seven perform during this time frame, and then how did the rest do? Right, the other 493 plus companies in the S&P 500, and you can see that the Magnificent Seven were down almost 2%. This goes a little bit into mid-October when we drew up the chart. Um, the S&P was positive over that time, despite the Magnificent Seven making up a majority, an overwhelmingly large portion of this index was still up 4.1%. And that's because the other 493 stocks that represent more of the everyday sectors of the economy were up over 7% since this inflation data reading came out. So it just goes to show that diversification and not piling into what's done well is really important. The other aspect of this is that this is a very healthy signal. That's the way I interpret it. Market breadth is a healthy signal that the overall economy is still doing well, and it's not these seven magnificent companies that are, soaking up all the profits and doing well and making up, 80-90% of the overall index return like we did and like we did see in 2023.
Right. Right. So I have to apologize. I had the a different box open. I didn't have the Q&A box open. I had a different box open. I thought it was the Q&A box. So when we were talking about the Fed funds rate and the Fed and the dot plot, someone asked, "Is this the 10-year U.S. Treasury rate?" And it is not. It's the Fed funds rate, which is a very short-term rate that they set. Can it influence the 10-year Treasury? Sure, it can. There are a lot of other factors that influence 10-year Treasury rate, but to answer your question, no, that is not the 10-year Treasury rate. But back on to the topic on hand.
Yeah, so I think it's worth,
Mhm.
just recapping the last two slides. There's been some pretty big market shifts underway. If you just look at the S&P 500 or global stocks, you might not see it, but these are shifts and trends we're noticing that's, it's benefiting client portfolios. And I think it's signaling some underlying health within the overall economy, which is a good thing.
Right. So let's move on to the next slide, which I look at it as a reflection on our human behavior. As human beings, we are built to avoid danger, to love safety, and that is what we saw some investors doing back in 2022, 2023. They were turning to us and saying, "Why would I ever invest in stocks when cash is earning me 4% or 5% risk free? Why would I ever, put money in the stock market when I can get that?" Well, if we remember at the time, inflation was well above 4%, well above 5%. So in fact, your guaranteed return was actually losing you purchasing power every year. Um, but beyond that, if we kind of take a step back and we say, all right, if we're only looking at your excess cash, not the cash you need for something in the next month, 2, 3, whatever the time period is, but your excess cash, was that better off in stocks, bonds, or cash? And what we find is, this chart tells you why, it's not always best to, focus on that guaranteed return, why it makes sense to put yourself in a position to benefit from the potential returns of the stock market. And what we see here is over the time period we looked at, right? We said, you know what? Let's look at when the 3-month T-bill, which is a common proxy for cash, when that surpassed 4% for the first time. What would you have been better off doing? Would you have been better off staying and holding that cash, or would you have been better off in the global stock market? Clearly, by this, you would have been better off in the global stock market. The answer to your question of why would I ever invest in stocks when cash is earning me 4 or 5% risk free is, well, there was a 40% plus return potential built into the market at the time. Of course, we didn't know that for sure, but it's something we definitely need to keep in mind as investors as we keep moving forward.
I think it just stresses the importance of having a plan in place,
Right.
right? So for our clients who have gone through this process, the importance that that shows, taking all those puzzle pieces in your life and putting it into what is a complete and whole puzzle that you can invest in with purpose. But for those who haven't done that, you should know how much cash you need on hand, and everything else should be invested according to the goals and objectives that you've set forth in that plan. And so any excess cash here, it would have been very easy to remain complacent and say, well, at least I'm getting 4% on my cash. A couple of years ago, I was getting 0%, right? Wrong. You missed out on 40% gain, market gain over just a couple of year period. Even if the market had dropped, if we did have a recession or something like that, as we'll see on the next slide, you would have made it back pretty quickly anyways. So again, it's about having a purpose for the different buckets of your money and understanding that goal. If you haven't walked through that process, reach out to your advisor or reach out to us, and we're happy to start that conversation. Um, I just think it's fantastic here. There wasn't a single day when cash was better than markets as soon as the 3-month T-bill yield surpassed 4%. I don't know if this has always been the case historically. I doubt it. But looking at this scenario, it really would have been poor decision making to think you can time the market and be okay in cash with money that should have been invested in stocks. Even bonds have outperformed, but the road has been a little bit more rocky. You can see there in October of 23, that was when interest rates on the 10-year longer term interest rates hit 5%. There were fears that the Fed was going to raise rates a lot, inflation was not going to be coming under control, and we saw bond yields rise, and that hurt the value of the aggregate bond market. But still, over a longer period of time, you expect to earn more yield on corporate bonds than you do on treasuries. So that's where we're seeing that outperformance over longer periods of time.
Sure. Sure. And you mentioned timing the market, which is a great transition to our next slide. But before we do that, I'm going to circle back on that. Before we do that, someone asked a question. Does Warren Buffett's sell-off of Apple and Bank of America reflect a similar trend as the Mag 7 slide, or such a change or shift in economy versus tech companies? Now, I'll say that what a lot of people don't realize is Warren Buffett is in the insurance business. He's writing insurance and then using his investment portfolio as collateral for that insurance. A lot of property casualty type insurance, a lot of reinsurance. So there are a lot of things going on, a lot of decisions he needs to make beyond, is Apple or Bank of America the best stock, right? Some of his trades, sometimes when he's raising cash, it can be more linked to the fact that he just needs to raise cash because of a risk that triggered on one of his insurance holdings or one of those other business matters within that insurance industry itself. So it's really complex. I know the media likes to talk about Warren Buffett's buys and sells like everyone needs to follow suit. But, we do need to keep in mind that there is a lot more going on there. And just because he's selling something doesn't mean it's because he doesn't like it anymore.
I think it's also worth noting he probably was sitting on massive embedded gains within those portfolios. I know at one point, Apple grew to be about 50% of his investment portfolio. I'm sure everyone here would agree that that's maybe irresponsible for any individual to do, let
Right.
alone a company. with shareholder duties. So, and then Bank of America, he helped, bail them out and buy a bunch of their shares for pennies on the dollar back in 08, 09. So, I don't know exactly what portions of his holdings he was selling, but, it might be a massive number. Oh, wow, Warren Buffett sold $10 billion of Apple stock. Well, they're a $1 trillion company, and half of their investment portfolio, which is about a quarter of their market cap, was tied to Apple. It was quite absurd when you think about it that way. So good points all around, and great question.
So circling back on timing the market, we did look at one indicator that investors commonly use to try to time the market, and that is the yield curve and the inversion of the yield curve. And what we have here on the slide is when the yield curve first inverted and then when it uninverted. That's when we started the clock and when we ended the clock. Can you talk to us a little bit about that, Adam?
Yeah, this is, the yield curve is often seen as a leading economic indicator, and I'll briefly describe what the yield curve is. Essentially, we want to look at what the yield of different duration of treasuries are. So you have the overnight rate, the federal funds rate that we've talked about being around, 4.75% to 5% today. And then you have a 1-year treasury, 3-year treasury, 10-year, et cetera, going out down the line. And typically what you see is with any debt instrument, the longer you're going to lend out your money, the more yield you expect to receive in return. There's a greater risk that more things could happen, you won't get repaid. So you expect the curve, it's called, to look more positively sloping from bottom left to upper right. Um, that's a normal yield curve. That's what you tend to see in periods of economic growth. In recessionary environments, sometimes what you see is an inversion of that yield curve where the Fed has raised rates on the short end, and then the longer term growth expectations start to come down, right? And that's what's called an inversion of the yield curve. There's, a joke basically that because not every time the yield curve is inverted, we've had a recession. You could say it's predicted 20 out of the last 4 recessions, right? Or whatever the number is and whatever the joke is. But it's not a tried and true, because this happens, we're going to get a recession indicator. But if you use it as such, you could run into problems, right? And that's what we wanted to show here. So the blue line is global stock returns. The green line that you're looking at is the aggregate US bond market index. And then we've got the steady gray cash line there as well. And what you can see is right when the yield curve inverted, there was a lot of stress in the market, and both stocks and bonds went down because the Fed was aggressively ramping up. That was the Jackson Hole speech in August that he made, Powell made, talking about how they're going to need to raise rates and raise rates a lot to combat inflation. And that did spook the market. There were some people out there calling for recession as well. But we never got one, right? And you see the market rally and recover from that point, thereafter. So I think it's worth noting that you could have timed the market here if you had flipped off that switch, hit the sell button. But by the time the yield curve actually uninverted, so if you're using this indicator as an all clear white flag signal, you would have had a great opportunity cost of over 20% being holding cash while the market was up, 31.2% there that you can see. So
Right. I'll also add, Adam, that it is very easy to get out of the market. It is a lot harder to get back into the market, right? When the market falls 10%, a lot of people are saying to themselves, especially after the yield curve inverts, and you're hearing the news going on of the day, the market's down 10%. A lot of people are saying it's going to fall another 5, it's going to fall another 10, and they want to wait and they want to wait. And sometimes it works out, but there are a lot of times in history where that doesn't work out. It quickly turns on you. And it just goes to show how hard it is to get back in, because that's not how our minds work.
yeah, again, going back to having a plan and a purpose for your different buckets of money, if you're meant to have a certain allocation of your portfolio invested for long-term growth, you have no business trying to time the market. You're way worse off if you make a bad mistake and get caught up behind than if you just ride the ups and the downs along the way. So this is an important reminder to show you, hey, look, if you had timed the market, you had about a month and a half to get back in at lower prices. Otherwise, we were right back up to, equal and on par with cash rates, and you're getting left in the dust if you didn't pull the trigger at that point.
Right, right. Let's say you're a balanced investor, 60% stocks, 40% bonds. If you miss out on 20% upside of the market, right, the only way to catch up to the market would be to somehow leverage your returns, right, to make up that miss. If you're a 60, 40% investor and the market drops 20%, well, guess what? You have your 40% in bonds you could put in stocks to help you recover even better when the market does recoup its losses, right? So it's also a strategy question of, well, if I'm wrong when I try to time the market, how can I recover from that? Versus if I'm wrong for not trying to retime the market, how can I recover from that? And it's a lot easier to recover from a drawdown or to play a drawdown. And I'm not saying put all your 40% into stocks, but to add that 5% or 10% extra in stocks, or just rebalance the 60-40 to help you, emerge from that in a better position.
Volatility happens all the time. It's something we have to accept as long-term investors, right? That's the price we pay for longer-term growth. So if you can't withstand a 5, 10, 15% drawdown over a short period of time, you probably shouldn't have that money allocated towards stocks in the first place.
Right. Right. So it is the election. It's election day. I know I voted, you voted. Uh,
Got my sticker here.
let's do this one more time. So, it's the market's at all-time highs. We have an election. What should investors be doing?
Nothing. I hate to bury the lead there, but no, I think what I'll say is, first of all, everyone should get out and vote if you haven't done so already. It's our right. You should take advantage of that. Um, but I think it's important to note that the market can do well no matter who is in office. Not only does it not matter as much who actually wins the presidency, but more importantly, I would say the makeup of Congress as well, right? So you can see in both the Democratic president scenarios on the left and the Republican president scenarios on the right, you have above average market returns when there's a split makeup of Congress. Okay. You also have historically better than average returns when there is a divided Congress and presidency as well. So, look, I don't want to get into this too much. Everyone's got enough stress and crazy news being thrown at them from the election that's going on today. But I think it's important to take a step back, recognize that, you know, people are just probably stock investors, I guess, are, you know, happier that it's behind us so we can look towards whatever the next big fear is going to be in the marketplace, than actually who caring about who wins ultimately at the end of the day.
Right, right. Politicians know that our wallet is a very powerful tool for them. They know that if they can convince you that one side is going to be worse for your wallet than the other, right, that could help move your vote. And so they push it. And sort of the media companies, right? They push it as well. It is entertaining to talk about, but we need to be cognizant of what the history tells us. And the history tells us that it doesn't really matter. The same goes. I know this is a very emotional election,
Yeah.
and you're not alone by thinking, if the other side gets in, it's not going to be great for the market. But when you actually look at the returns, when a Republican gets into office and you ask Democrats what they think of the next 12 months in the stock market, they almost, I believe every single time I've seen charts on this, I'm pretty sure it's every single time they feel like the market's not going to do as well. When you reverse that and a Democrat gets into office and you ask a Republican what they think of the next 12 months, what will happen in the next 12 months in the stock market, and they routinely say it's not going to do as well. But when you actually overlay that with how the market did do, the market doesn't care. Right.
Yeah, I mean, it's just never a good idea to mix emotions with investing. At the end of the day, capitalism doesn't care how you feel. I know that's sort of callous to talk about and dumb it down in that manner, but we're talking about the future prospects of corporate earnings in America or around the world. And think of put yourself in the seat of a CEO of a major Fortune 500 company. You have a board of directors to report to. You have shareholders. It's your duty to increase shareholder value, right? That's your charter. I, Most people just want this to be passed and know the results so that they can plan for the next 4 years or 2 years until there's another midterm election, right? So that's where when you think about it from that perspective, you can see how gridlock becomes favorable for stock performance, because nothing major in terms of legislation can get passed. It needs to be a bipartisan effort in Washington to pass any laws with a divided Congress or contrasting presidential and congressional parties. So
Right.
um, I think we've talked a lot about this. We can plug a couple of our last few podcast episodes, Amplified Wealth. We've talked to Mike Townsend, the political boots on the ground analyst for Charles Schwab in DC. That was a great conversation. And it was back in July, but I think I re-listened to it recently, and it's all very applicable today. It talks a lot about what's at stake, future legislative changes, what the market cares about. I would recommend everyone go and check that out if you want to hear a little bit more on this topic.
Right. Right. And I get it. You might be sitting there saying, how can, we're talking about the leader of the free world here. How can they not influence the market? There are a lot of checks and balances out there, and there's also a lot of cross currents occurring that are impacting what's happening in the markets. Even if you were to get the guess of who's going to get elected next, right, it's very hard to understand or place the right bet on the right industry or asset class, right? We brought this up in prior podcasts. When Trump got elected, he was very pro oil, right? And when you look at how oil companies did over his term, they did miserable relative to the rest of the market, right? When Biden got into office, people said, oh, he's pro green energy. Green energy companies are going to do really well. Well, guess what? Over his term, green energy companies did very poorly relative to the rest of the market. So even if you get the who's going to be the next president question right, it's still very hard to imply or to make a correct investment choice on top of that. So
Yeah, I mean, talking about sectors, industries, it becomes, every time you deviate from the market and bet on financials versus tech, or, energy companies versus oil companies versus green energy companies, you're taking on risk in your portfolio, right? So I think having an advisor who's going to work with you and look at your entire portfolio holistically based on what your goals and objectives are, it becomes a really important aspect of what we do for our clients.
right. So we showed the chart earlier about, how you were better off being in the market versus staying in cash, right? So if we look at that and say, you know what, you're right, guys, I should have been invested in the market, but now there's the election, there's the Fed, there's all these risks, should I put more, is now the right time, right? It's always the question, it's now the right time. You can look back and say, oh, I made the wrong decision, but then it's always now the right time. So we thought we'd zoom out and focus on a few slides to maybe help with that question. So can you
It's
tell us a little
almost
bit about this?
always the right time to invest if you have the excess cash. But what we did here is we just wanted to put a different perspective to calendar returns for the market, right? So since 1928, including all the years of the Great Depression, all those bad years, all the good years, we wanted to just look and lay out a distribution of those returns. You can see on the bottom of this chart, for those watching, for those listening, we break it down into buckets of 10% ranges. So all the way on the left, you have the worst year for the S&P 500, down 43.34%. Then you've got your minus 40 to minus 30 range. There's a couple instances there, and so on and so forth. You can see in yellow on the left was 2022. That was a minus 18.11% year. I think it's fascinating to see that there were actually only 6 calendar years since 1928 worse off than 2022. It was a historically bad year on a calendar year basis. You can see in the blue in the middle of the chart there, those two are highlighted because the average return on a total return basis for the S&P 500 is about 12.1%. So that's average. And then you can see we've highlighted 2023 there at 26.3%. This year's shaping up to be another it looks like 20% or so a year as of today. Hopefully, we get a nice rally after the election and some of that uncertainty is alleviated and it turns out even better. But it's worth noting, just looking at the shape of this bell curve, we have a tail skewed out to the left, and a majority of the instances of returns are sort of in that 10 to 30% range, right? Um, if you want to extrapolate that even further, really the 0% or even like down a little bit, the minus 10 to, 40% plus returns is where you find a vast majority of market returns. So what this says to me is more often than not, the economy is growing. People want to make more businesses, people want jobs, they want to earn money, they want to spend money. And it takes those big, bad, ugly events every so often to come in and upset the apple cart, right? So it's more often than not, we should be looking at through the lens of, you know, let's not time this. Markets are going to be good more often than they're going to be bad. And when they are good, they're really good, right? The fear of getting and the pain of getting a bad year is much worse than the joy we experience of those good years. But when you visualize it in this way and in this manner, it becomes obvious that focusing on the long term and making sure we capitalize on those good returns is very important.
Right. What I like about this slide is we look at all these calendar years, and there were risks occurring during almost every calendar year we're showing here. I would put money on the fact that I could find negative news articles in every single one of these years, right? Yet the market was still up roughly 75% of the time.
Yeah.
So I think that just goes to show how hard it is to derail a growing economy, right? The economy's growing. Yeah, there's all these cross currents, there's these wrenches getting thrown in the way and things like that. But if the economy's growing, the stock market will grow over time.
Yep. Yeah.
So,
I,
mhm,
I think, even in some of these good years, it's worth highlighting that you can get massive drawdowns and massive corrections
right,
within them, right? So 1998 comes to mind where that year was up 25%, but in the middle of the year, we actually had peak to trough, a sell-off of 20% in the middle of the year. And we still closed the year out up 25%. So the volatility spasms that you see can be short, sharp, very scary when they're happening, but you need to have that long-term perspective when it comes to stocks.
right. All right. So again, I hear what you're saying, guys. I should have been invested in stocks. You know, there are always risks out there, but the market is at all-time highs, right? Why would I put money to work when the market's at all-time highs? Well, we actually, as a company, we looked at that, and if we look at the left-hand side chart here, we looked at, well, if you were to invest any day of the year and then look forward 3 months, 6 months, 1 year, 2 year, 3 year, 5 years, or if you were to invest only at new highs and then look out those time periods, where would you have performed better and worse? You would think that you would perform worse investing at new highs and
Right.
better just investing any other day. But what we find is you actually, especially when you go the 6 months, 1 year, 2 years, 3 year, 5 years out, the longer time periods, you actually were better off investing when the market was at an all-time high. Strength begets strength. And so I know it sounds counterintuitive, but if you're questioning, oh, it's at an all-time high and that's your reasoning, I think you need to take a second look and just understand that it doesn't really matter if we're at all-time highs or not. That shouldn't be the indication of whether to invest or not to invest.
I mean, think about it. If you have these all-time highs actually tend to sort of cluster with one another, right? You think about the last year. We set a new all-time high, but then we just kept going higher and higher. And there's a reason for that. Again, stocks represent forward earnings expectations for the largest companies in the world or in America or whatever index you're looking at, right? So if we expect that we're going to have a sustained period of economic growth, I mean, think about it. The Fed is cutting rates. We're at full employment pretty much. Growth is doing okay. Um, there's reasons to be worried, but if you look at the fundamentals in this economy, you would expect that, next year's probably going to be better than this year. And that trend, if you have these long sustained periods of economic expansions, you tend to see these all-time highs cluster around one another. So it's a bit counterintuitive. That's not saying investing when the market's down is a bad thing. You should always be doing that, right? Dollar cost averaging is a good tool to build wealth over time and weather the downturns. But in not investing because you're at a high is not necessarily a good reason not to invest. In fact, this data suggests otherwise if you have a long-term outlook.
Right. So we have a little bit more time, and we did have a lot of questions come in around AI stocks, around NVIDIA, Taiwan Semiconductor, Microsoft, the Mag 7. How long will they outperform? Should I be selling now? Should I be buying now? And I don't think it'd be fair to treat this as just a buy sell question. I don't think we need to be all in or all out. I think one, we need to appreciate what AI and the technology companies are doing and the hold that they have in our economy and the increased demand we are expecting from them. But we do need to take into consideration that bubbles do occur, that investors tend to pile in on the hot stocks, right? So if you've been fortunate enough to benefit on the great appreciation in some of these names, I think you need to look at what percentage do these names represent of your entire portfolio or of your account or net worth, and say, is it time maybe to take some of my gains off the table? Right? It becomes a risk management question. You could
Yeah.
still stay in AI, but not be in NVIDIA, right? I think that's really the question that's the more productive question you should be answering, because you're never going to fully, get that buy sell question right. Should I be all in or all out? And you're always going to be upset with your choice in hindsight, unless you get lucky. Now, but what a better way to frame this is, what type of risk am I taking? Am I diversified? How much should I get? How much have I gained from that position? Should I take some chips off the table but stay in that position, right? I think that's the better question to be answering yourself, and it's really individualized on a person by person basis.
I would think back to our winter webinar that we did 3 quarters ago, and we laid out, if you recall, and for those listening or watching, or recurring audience, thank you for being a recurring audience member. But we called out all these major firms and their market forecasts for the end of the year. And we said, don't follow the herd. They tend to be wrong, et cetera. There was one person, one firm that predicted the S&P 500 would be at 6,000 by the end of the year. And they cited the fact that AI would turn into this big bubble and that would fuel a market rally and it was going to be overvalued. I think it's ironic that we got there to their price target, or we're close to 6,000 on the S&P 500, but these companies are making real money. This isn't the dot-com bubble, and maybe there's some extent of these companies that is overvalued. But what's the company? Supermicro is under investigation for cooking their books, right? There's always bad actors at play. But again, I totally agree. I think it becomes a risk management question. And, look, understanding that these things are going to be volatile, that means it could go up a lot, it could go down a lot too. So take money off the table if you're not willing to risk it all. But what else did you make all that money for if you've been a long-term investor than to enjoy some of the fruits of your labor or lock in those gains and go and reinvest in the market or hire us?
Right. I can tell you the two things you don't want to do is, you don't want to hold on to your full position and ride it all the way back down. And you don't want um, to sell the full position and then watch it ride up, 100% more. So definitely look at it from a risk management lens. Let's take some chips off the table if it makes sense and put them in other areas of the market, maybe even in the same sector or industry. But let's start focusing on a risk management and approaching the question that way. So shameless plug. We do have our podcast, Amplified Wealth. If you use the barcode on the screen, that'll bring you to the YouTube site of Amplified Wealth. However, you could also look up Amplified Wealth on any of the podcast apps you may be using, whether it's Apple, Google's, or Spotify has one. But I would definitely encourage you to go search it, look for it, follow it. We interview a lot of interesting people. We talk about a lot of great topics for for high net worth, ultra high net worth individuals, how you should be thinking about managing your money, what you should be thinking about certain tax situations and tax changes. Like Adam said earlier, we've interviewed people like Michael Townsend. He's the man on the street for Charles Schwab and Company in DC, talking to the politicians, shaking the hands, helping Schwab decide how they are going to approach certain political situations and choices. We've interviewed a director of fixed income at BlackRock regarding municipal bonds. So a lot of great interviews there, a lot of great content. I highly suggest you to take a look and to follow.
Yeah, this has been another great episode. Again, get out and vote if you haven't, but thank you all for tuning in. And if you have any follow-up questions, please reach out to your local advisor and we'd be happy to get in touch.
Great. Thank you.